please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
The results was that asset quality improved and we saw a fall in the gross and the net NPAs. Joining us now is Mr. R. Subramaniakumar, Managing Director and CEO of Indian Overseas Bank. Good morning, Mr. Kumar. If you can take us through this, have you peaked off, or do you think that with the new RBI rules, you may have one more or couple of more troubled quarters?
Good morning to you, Lata. The thing is if you just see it right from the beginning of this financial year, Q1, Q2 onwards, we said right in the beginning that our focus is to reduce our NPA. At the same time, increase our recovery in respect of the existing NPAs, which we wanted to do it on segment. First, Q1, almost my NPA slippage as well as the recovery was matching around 2,900 each. But next quarter, there's a Q2, if you see it, there was an increase in my recovery by 50% of that other slippage. Now in this current quarter, Q3, our slippage was 1,400, whereas the recovery is to the tune of around 3,000. So in this 9 months period, we made a recovery of 9,700 crores, whereas the slippage was to the tune of around 5,900 crores. In fact, the recovery for this 9 months is much higher than the 12 months of the previous year. This is mainly because of the fact that the bank has bite the bullet a little early and recognized the accounts much earlier than that of the industry. And which is one of the factors for not able to put up the PAT, the positive profit, is that the migration provision, aging provision, and of late that NCLT provision which is required to be added. If you look at the NCLT provision, what we did is we have taken the entire thing. The list 1 is consisting of, I have provided for the entire amount excepting 163 crores, which we will be providing it in the next quarter, which is a Q4. Whereas in the list 2, we have around 3,000 crores of account, although only 4 or 5 accounts have been admitted, we went ahead and provided at least 50% of it during this quarter itself. And only 326 crores I need to provide in the next quarter. This is for all the 16 accounts out of the 40 is there in my books. So recognizing the accounts in appropriate time is the order of the day, which we feel that we will be doing it. And if we're moving forward, what we feel is that, yes, there will be some stress will be there in the books because of the new direction, but it is not an immediate quarter on quarter. There is a 6 months period is available. So during that period, we feel, we firmly believe that the promoters are also very keen to protect their asset. They will try to maintain the account properly during this period, which in my view is good for the bankers as well as for the borrowers themselves.
So you expect this SDR, S4A cases to get resolved before 6 months. What is your own exposure to these cases, SDR, S4A cases?
We have around 4,000 crores of it in my book as of today, which is just reduced from around 8,000 crores plus. Yeah, this is a considerable reduction in that particular number as well.
Okay. So, in the very near term, because of this exposure that you have, are you looking at higher amount of provisioning that you'd have to make? And what kind of impact would that have on growth?
Yeah, if you look at this Q3, we made a total provision of 1,666 crores, out of which 1,250 crores is towards this migration or aging provision, as well as the provisions in respect of the NCLT. Having absorbed a considerable amount of this provision, going forward in Q4, we are likely to have the provisions more or less hovering in the same range. This is what we anticipate and then work out, because absorption has been taking place for long. The icing on the cake, what we feel is that the recovery which is hitherto not coming from the smaller accounts and the accounts which are below 5 crores and 1 crores, we see a lot of improvement therein. See, even in the last, this entire 9 months period, if you look at it, the recovery in respect of the written off account itself is come to the tune of around 550 to 600 crores, which we feel where we are technically provided for, this is going to add up to my bottom line. Moving forward, that is one of our strategy. In fact, if you look at my balance sheet numbers, 25% of my NPA we have provided for 100%. So this provides, I should say that we are sitting on gold mine. So we will be start mining it this area, and my entire branches started activating it, and we have put up a special team for recovery at the regional level.
So when do we see black on the bottom line, sir? We have been running losses for some time.
Yes, one of the reasons, if you look at it, operationally we are improving efficiency in our the scheme of things during this year, financial year 19. Maybe the Q3 is an area where we are aiming to. Of course, subject to all these ground rules remaining constant, we do not know suddenly any surprises being sprung by any other things and a regulator or a government. Otherwise, we are aiming to come out of quarterly profit by Q3 of financial year 19.
Oh, that's good to hear. Thank you very much, Mr. Subramaniakumar, for joining us with all those details. Aggressive recoveries is softening the blow of slippages for Indian Overseas Bank, lowest slippages in 8 quarters. Well, we continue with the banking theme since that is absolutely the talk of the town and uppermost in the market. Joining us now is MB Mahesh of Kotak Institutional Equities. Mahesh, good morning. Thank you very much for joining in what must have been a very heavy morning for you with all your clients asking you the impact, and we are going to ask you the same question. What is the sense you are getting? What percentage of stressed will walk into NPA, you think, for the system?
Yeah, hi, good morning. No, I think as Mr. Kumar just kind of explained, it's going to be difficult for you to quantify the exact amount. By and large, if you look at it in 2 ways. One, you have the existing stock of bad loans, which is around 10% of the loan book, which has already been recognized, and you have been kind of struggling to find a resolution plan around these NPS for the last probably since the AQR exercise which happened in 3Q FY16. The other one is what is the potential unrecognized stress which is sitting in the balance sheet of banks but is expected to slip over the next, let's say, 1 year's time. I think there the quantum of loans which is unrecognized is probably getting smaller and smaller. And outstanding stock, if you look at the entire stock of bad loans, it is probably not more than about 3 to 4 percentage points for the entire industry. So that doesn't seem to be a big worrying factor. What is probably more worrisome is what kind of recovery rates that you will potentially get if you have to push in a very large set of assets in one shot into the NCLT process. What kind of bids that you're likely to get, and that becomes a bigger issue when you're kind of managing this entire process through the NCLT route. That's probably the bigger concern for us as we speak today.
Okay.
You know, the overall feeling, of course, has been that in the long run this is very good because you know these schemes anyway were not working very well. So you know that larger question. Will you at any point buy public sector banks because you think that there is a cleaner regimen coming in place, or will you wait to keep the faith?
Sure. There are 2 parts to it. One, if you look at one of the challenges that we have, the NCLT process is still in its early stages. It's been just about a year. Many of the large ticket cases which has been referred to the NCLT process is probably closer to completion. We also need to see what are the bottlenecks or what are the challenges which is out there, which is pending to be addressed in this process as well. While we have probably reconciled to the fact that the SDR, S4A, 525, any other format has not been successful, we still need to see how the experience is on the NCLT process as well. It appears to be a lot cleaner. It can be faster given the time-bound resolution which happens. But we still don't know whether all the challenges have been addressed out there. To answer your second part, whether you would buy public sector banks on the back of this specific development, you kind of use this approach saying that, look, at some point of time, if there is some value sitting in some banks, you would obviously kind of look into it. As we speak today, we do have a few PSU banks which is under the buy regime. So we recently upgraded Bank of Baroda. SBI has always been there as one of our preferred ideas. So that doesn't change. So if there is value into it, whether it's a public sector banks, private sector banks, you would definitely want to look at it at some point.
Okay, Mahesh, good morning. You know, I wanted your thoughts on the big trade that the market is taking today, which is to buy into NBFCs, because the big risk was that you know, that easy sort of game for NBFCs was over and PSU banks healthy again would compete. Do you think that is reversing again? I mean, do you have coverage on any NBFCs?
As a house, we do, but I don't kind of primarily look at that space. But having said that, you know, you see, you've seen correction in a few names as well. At least for the last 6 months, you've seen a few stocks kind of underperforming out there. So you would see some bits and pockets of ideas kind of coming into the market. So you're probably seeing one such trade as we speak today. But yeah, directionally, it's not like we've changed our opinion on some of these names.
So you said you've upgraded Bank of Baroda and you continue to have a buy on SBI. Do you think corporate-facing private sector banks like ICICI Bank, etc., have a better ability to absorb the impact of higher provisioning purely because of better capital positioning maybe? And how are you placed there?
Yeah, sure. So we are the last few years we've been kind of playing this theme. So our entire call has been that there is a decent rate to kind of play in the corporate banks. So we've liked ICICI Bank. It's been our preferred idea in the overall space that we have. Axis, we've kind of moved our recommendations on either side depending on what price it is. But yeah, what you're saying is perfectly right. They have a much stronger balance sheet. They are well capitalized. They have 50% of the loan book in retail, so a much smaller composition of the loan book is exposed to the corporate side. Much of it has been recognized as we speak today. So the further impact that you're going to see in their P&L is going to be much lower. So to that extent, they are good ideas to own, and we probably feel that playing the corporate banks is an important theme that you would want to kind of play even today, irrespective of whether the recent development has been positive or negative.
Nevertheless, you may want to rework their book value. The book would move down a bit for next year, and therefore the price to book also moves down.
See, there are two things here. There is a book value which is reported by banks, and there is an adjustment which most analysts and fund managers use. The adjustment can be reasonably subjective in nature, but most of us have been over the past few years assuming that a fair amount of stress which is sitting outside the reported gross NPA numbers will eventually slip into NPLs.
Okay.
And if banks have been kind of consistently under providing on their coverage ratio as compared to what the expectation is, we make further adjustments to the net worth. So we kind of look at these adjustments beforehand. So this development does not change the outcome on the back of that. So price to reported book, yes, you would see a correction, but our adjustments will be quite minimal.
Okay, and what's your view? You spoke about names like ICICI Bank, etc., but what's your view on Yes Bank now?
So as one stock, we've had a negative rating for some time. Our primary concern has been around the one on the asset quality issues. Some of it has, rather most of it has probably kind of been is kind of recognized by the bank over the last few quarters. We've also a little bit concerned whether the ROEs can sustain at these particular levels. And hence we've kind of felt that if you were to play corporate banks, which is where Yes Bank has a predominant share of its loan book, you are probably better off owning an ICICI Bank, getting much better upside rather than playing the Yes Bank idea. So that's how we've kind of positioned on the bank as we speak today.
All right, Mahesh, thank you very much for sparing time for us in what should be a busy morning for you. Thank you for joining us. So that's the word. Most of the stress was probably already factored in by analysts. Let's get to another company which reported a strong set of numbers, Mahanagar Gas. Revenue growth was strong, led by a robust growth in volumes, both in CNG and in the PNG segment. Margins, of course, have been lower sequentially. Nevertheless, high, I mean, better than many estimates. SM Ranade, the CFO of Mahanagar Gas, joins us now. Good morning, Mr. Ranade. Well, first up, can you take us through what you see as volume growth? This one, at least PNG volumes up 4% quarter on quarter, was quite a positive number. What can be the run rate in fourth quarter, Q1 next year?
Good morning. You have rightly said the volume growth was pretty impressive this time, and the overall growth has been 7%, made up of around 6.5% of CNG and around 8.5% of PNG, which consists of domestic, industrial and commercial put together. More particularly in PNG, the growth in domestic sector has been double digit. In fact, it was almost 11% growth which we have clocked into. Going forward also, this I think momentum is likely to continue. CNG, some conversions we have seen last couple of months, also the conversions are on upper side. our attempts for connecting more and more domestic connections should also continue. And assuming one or two bigger industrial customers come up in the forthcoming quarters, we should see similar growth trajectory. I mean, historically we have been growing at say 6% CAGR on 5-yearly basis. We expect similar growth should continue.
Okay, what about the profitability, Mr. Ranade, and also the margins, because that is where we have seen some stagnation. Do you think you'll resume growth on that as well?
I think what you are referring to stagnations probably with reference to Q3 results versus Q2, whereas if we compare Q3 for this financial year versus Q3 of previous financial year as well as 9 months results versus 9 months, there has been in fact in improvement in EBITDA margin as well. Absolute EBITDA has also increased and the margin has also improved a bit. Only question, slight drop which we have observed in Q3 versus Q2 of current financial year, EBITDA I think it was some 1% drop or something, which has predominantly happened on account of two reasons. One is the OPEX has been higher in Q3, which is a normal case. I mean, historically also the OPEX for the company is higher in the second half, and which is what has happened even this financial year, which is not an exception as such. Another thing, the industrial and commercial customer category, you must be, industrial and commercial category, the gas supplied is imported RLNG. On spot basis generally we supply. The spot prices have been hardening. I mean, earlier in the financial year we had procured it even at $6.50 kind of thing, whereas now it has reached almost double digit. That was another reason why margin, if you compare Q3 to Q2, some impact was there. At the same time, the impact was not very severe even in industrial and commercial, because while on cost front we faced some challenge, but on sales realization side there was significant improvement both in industrial and commercial.
In fact, I was coming to that because your gross margins have actually improved to 12.7 rupees per standard cubic meter. What kind of growth would you expect in gross margins over the next few quarters?
When we talk of gross margin, number one, we should look at different customer categories: CNG, domestic, industrial and commercial. Both CNG and domestic, the supply of gas is domestically produced gas. Now the price rise in case of this priority sector has already happened in case of procurement of gas, which is based on formula set by central government. So until at least 1st April there is no likelihood of the price rise further. And even if we assume that there is a price rise on say 1st April for domestically produced gas, I think there is enough headway available for us vis-a-vis discounts which we offer to either in domestic customer categories for LPG, I mean as compared to LPG connections, as well as discounts which are being offered vis-a-vis diesel or petrol. So hopefully the increase should not be very steep, but whatever increase is there we should be able to pass on. So as regards per unit margin on domestic and CNG, we expect it should be stable even immediately going forward. Whereas industrial and commercial unit margins will be predominantly dependent on the what is the rise which is taking, if at all, in case of spot prices of imported gas, vis-a-vis what is the increase in our sales realization will happen, which will be dependent upon the alternate fuels like LSH, SFO, which in turn will be dependent on the oil price levels. So proportion of increase in oil price levels or alternate fuels vis-a-vis proportion of increase in spot gas prices, that is what will determine what will happen to industrial commercial margins.
We are in yet another session of profit taking, especially when it comes to the crude oil prices, trading at a 2-month lows on your screen, 0.5% down, and this is after the US weekly report is suggested to show an increase or a build-up in the US inventory data there. Also, the OPEC monthly report and the IEA data that has come in the last 24 hours does suggest that the supplies in the global markets are slated to continue to increase, and the demand actually could be following behind, and that's what's been weighing onto the prices. We are trading at around 0.5% down in the Indian markets as well on your screens. The gold and silver prices have seen some support, and this is on the back of decline in the US dollar. The dollar index is trading at a 1-week lows, in turn giving some support to this sector. The base metal prices have been quite volatile. On one side, you have the weak US dollar, which has been supportive. But on the other side, remember, China is headed for a week-long lunar New Year holidays. From 16th to 21st, China markets would be shut. Excuse me. And that's really weighing onto that space. The other area that has seen a lot of movement and decline has been the rubber prices. 8-month lows is how it's trading in TOCOM. In the Indian markets as well, if you look at the year-on-year prices, they have declined by 25%. So from where we were trading in last Feb to now, the prices clearly have seen a lot of decline coming in. Trading strategies, and we have them from Angel Commodities. They are talking about crude and gold in the day-to-day. For the zinc prices, in the meanwhile, they have a buy call coming in. 225 rupees is what they are seeing on the upside there. A buy call also continues in case of the crude oil prices, where they're looking at targets of 3,870 for the day-to-day.
Okay, Manisha, thanks a lot for that. I think the market heard you, that point you made on rubber prices, because if you take a look at the tire stocks right now, they're making the highs of the day, and that's a significant dip that Manisha is talking about. Indian rubber price at 123 rupees a kg, but the high was 158, so that's a 25% decline, and 8-month low for the global rubber prices clearly is a big move. So the bigger tire stocks, the likes of CEAT, Balkrishna, MRF, they've all moved to high point of the day, so that's been a big talking point in the commodity market. That's all the time, of course, that we have on Bazaar. Up next, we have Chartbusters.